morning, everybody. Thank you again for joining us for another edition of the Wealth Guardians radio show. I'm your host, Doug Ray, and I appreciate you spending some of this weekend with us. Jeff Brown, known as JB, and Bryce Payne are here with me today. Hey, guys, how y'all doing today?
Morning, Doug. Doing good.
Morning.
Good. Hey, before we get started in today's show, like always, I'm going to salute our men and women who are in the armed forces and also our first responders. Thank you so much for everything you do and the sacrifices that you make.
Well, we'd like to welcome everybody to the show. Hello again. Welcome to our show. We've got a lot of great information for you. Doug, before we went on, I got to tell you, we were talking about the Great Recession and how tough it was on many folks. You mentioned some folks who retired just before the recession and how many of them were financially hammered. Now, I guess I never thought of when a person retires, it can have such an impact on your life. After all, none of us can see the future. What is one to do?
Yeah, JB, that's where solid planning comes into play. In this day and age, you have to prepare for all kinds of contingencies, especially poor financial market and business downturns, because honestly, they're going to happen. They're going to continue to happen. In fact, since the 1929 stock market crash, we've had 13 market cycles in which we've lost 20% or more. That is the classic bear market. If you do the math, that means it occurs every 7 years on average. So guess what, JB?
What?
We are way overdue. This current bull market started in March 2009. That makes this bull market over 9 years old. And here's an interesting side note. The actual day was March 9th, 2009, and the S&P 500 closed at 676.53. But do you know what its intraday low was that day? Take a guess.
Now, I have no clue. I'm a radio guy. Come on.
I kind of figured that. Well, believe it or not, the intraday low was 666.
Oh.
Now, I have no idea what that means or if it means anything at all. Probably doesn't, but just a fun coincidence I thought was interesting.
Well, guys, since we're on this topic, let's climb into our Wealth Guardians time machine and let's travel back to 2007 and meet Bob and Carol and see how they were affected.
Okay.
Just imagine you're Bob and Carol, you just retired, it's 2007, everything is looking great. Stock market's up, your IRA's worth $1.5 million, and your broker's telling you he can get you 8%, 9%, 10%, even 12% returns on that moderate to conservative invested portfolio of mutual funds. And you're pretty good at math. And so you believe you can take out 6% of income from your IRA if you're earning 8 and 12%. That's a no-brainer, right?
Right.
Life couldn't get much better. You're both 65. You have $40,000 of annual combined Social Security income, $20,000 in a pension, and you plan to take $90,000 from your IRA. That's 6% of $1.5 million. You hit your retirement income goal of $150,000 a year, projected retirement income. Well, as 07 goes by, the stock market drops 10%. Your broker says, don't worry, ride it out. You're in it for the long haul. You got to stay in this market. So each month, you take out your $7,500 of income on your portfolio and you continue to pay the fees. At this point, you're not too concerned. Then the stock market drops a second 10%. Your broker says, don't worry, ride it out. You got to be in the market. So, he sounds convincing. Each month, you take out $7,500 of income from your portfolio, continue to pay the fees. Now you're worried this ride it out thing is starting to sound like a bad recording. But your broker, again, convincing. Now the stock market drops a third 10%. Your broker says, don't worry, ride it out. You're in it for the long run. Again, you're taking another $7,500 of income from your portfolio, and you continue to pay the fees. You're very worried until your broker, you don't want to ride it out anymore. You want out. You've lost too much money. He says you can't get out now. You got to make it back. Basically, you're stuck. The stock market then drops a fourth 10%. Your broker tells you, don't worry, ride it out. You're in it for the long haul. You got to stay in the market. Again, each month you take out $7,500 of income and continue to pay the fees. Now you're in a panic. You feel paralyzed and hope somehow, some way you'll get out of this mess. The stock market then drops a fifth, 10%. And again, your broker says to you, you got to stay in this thing. You got to ride it out. You're in it for the long haul. And again, every month you take out $7,500 of income and continue to pay the fee. You can't believe it's actually gotten worse, and now you really don't know what to do. Well, the stock market drops another 4%. Your broker says, don't worry, ride it out. You got to be in it. And again, each month, $7,500 of income comes out of that portfolio, and you continue to pay the fees. The perfect life you had seemed to have is so far away. You're sad, unhappy. You feel very, very guilty for letting yourself get into this position. In 18 months, the stock market dropped 54%, and many retirees lost even more than that. The entire financial industry, your world, your retirement was literally rocked off that beautiful dream and thrown into the nightmare they called the 2008 financial crisis. After going through 2008 with your money, what is the one thing you never, ever, ever want to happen again? You never want to go through another 2008 again. Another 54% drop in the market, taking out income and paying fees on your $1.5 million of IRA has now dropped your account down to $596,000, and you have no idea of what to do. You're numb. You meet with your broker, and he can't explain anything to you that you understand other than you only have $596,000 left of your original $1.5 million. Now, here's a side note. During this 18-month time period, you paid $59,000 in direct and hidden fees. Your broker said you're only going to pay 1.25% in fees, but he didn't tell you the whole truth. The 1.25% was just what you paid him. You also paid 2.25% in hidden fees like mutual fund expenses, trading costs, custodial fees. Over 18 months, you paid total fees that are now about 10% of your total current portfolio value. This is sickening, but it's what we find the average retiree is actually paying in fees is about 3.25% per year. But you have to make a big choice. The market's crashed. Your portfolio is down to $596,000. As a great Money Hall asked America over and over again, let's make a deal. Do you want to know what's behind door number 1, door number 2, or door number 3? Behind door number 1, you continue to take the $90,000 of income every year, but now $90,000 becomes 15.1% distribution rate. Remember, you're pretty good at math, and taking out 15% probably doesn't sound right to you. If you continue to take out that much money and pay the fees, by 2016, you're only going to have $260,000 left. You only have 3 years left of income. You're both 74 by then, with a 75% chance that at least one of you will make it into your 90s. Well, let's see what door number 2 has for us. You significantly decrease your annual income from $90,000 to $35,760, meaning your monthly gross income dropped from $7,500 to $2,980. You earn market returns, pay the fees, and by 2016, your portfolio's worth $820,000. Your portfolio's higher because you took out $434,000 less income. So much for those travel plans. Well, let's see what's behind door number 3. You stop all income from the portfolio, dropping your annual income from $90,000 to zero. Your monthly gross income is decreased $7,500 to zero. You earn market returns, pay the fees, and by 2016, your portfolio has grown to $1.2 million. You have money in the portfolio, so let's just do a recap. Choose door number 1, you run out of money when you're 74. Choose door number 2, receive $4,020 less income. Choose door number 3 and receive $7,500 less income for the next 8 years. But old Monty Hall, he likes you, and he's added a bonus door. Door number 4, get your old job back, work full time for the next 15 years. Which door would you choose? None of them seem very good. Can you imagine if you really had to go through this yourself? The good news is you're not Bob and Carol. The other good news is that now, during our current time frame, the stock market is near all-time highs. The bad news is that the stock market drops on average 39.5% every 7 years since 1929, which means we are about 2.5 years overdue for another market crash, which means we owe the bear a lot of money. The next big crash is coming, and it's not if it'll happen, it's when will it happen. You'd probably do anything to guarantee yourself a successful retirement. One problem is you don't know where to start and who to turn to. Another problem is it all seems overwhelming. The biggest problem is you don't have a roadmap of exactly what you need to do. If you had such a roadmap, that would guarantee your financial security during retirement if you followed it religiously. You've accumulated a lot of money because you're a disciplined saver. All you need is that elusive roadmap. Well, we're going to give you that roadmap. How much is something like that worth? Hey, a lot of advisors charge over $5,000 for such a roadmap. But we're not going to do that. We're going to give this to you absolutely free. We're going to show you how to put together a bulletproof retirement plan that's going to insulate you from the next bear market. All you have to do is give us a call at the office at 336-391-3409. It's absolutely free with no obligation. Well, we're going to have to go into a break, and when we get back, Bryce and I are going to have a few more comments about the recession of 2008 and how that affected people. You're listening to the Wealth Guardians right here on WPTI 94.5 on your dial.
And welcome back to the Wealth Guardians radio show, where we tell you what you need to hear, not what you want to hear. Now, today we are traveling back in time to look at the Great Recession and how it devastated Bob and Carol's retirement. Doug, that was a pretty gut-wrenching story you told before the break, and I never thought of it like that since I was not of retirement age and, still working. Yes, I looked at my 401k and got sick to my stomach every quarter that I got the statements, but at least I didn't depend on the 401k to live on.
Yeah, JB, that market downturn was devastating for many. Trillions of retirement dollars were wiped out in 18 months. And do you see why I have for the past 11 years on this radio preached to retirees to become safer with their money as they get older? I'm never going to forget that recession, and for months on Saturday morning, we were doing a body count. Well, not of dead people, but what was happening back then was the Fed would close failing banks on a Friday afternoon. They'd march in and shut the whole thing down. I'd get up at 4 o'clock on a Saturday morning, do the research on which banks across the nation were closed, and then come back in and report it on my show at 8:30. And let me tell you, there were several banks that hit pretty close to home. Wachovia being a prime example. The feds didn't close Wachovia, but they forced Wells Fargo to buy the carcass that was left. Oh, those were gloomy times. And when the next financial crisis comes, and I did say when and not if, I am really afraid it's going to come out of nowhere, and it's going to be much worse than 2008. So now's the time to prepare while the market's good. And I'm not talking about getting out of this market, but I am in talking about installing some fail-safes, some circuit breakers, if you will.
Absolutely. And Doug, that technology exists now, and we have it on our actively managed equity portfolios. So what we do is we provide our clients access to multiple actively managed investment programs of varying strategies and risk exposures. And one that you and I feel is particularly suited for those approaching or already in retirement is a program that is structured to limit downside market exposure during your bear market cycles. And this helps significantly to shorten recovery periods and is less impactful on drawdown strategies than those passively managed portfolios that probably most listeners have. Now, Doug and I invite anyone who is concerned about what the next market correction might do to their retirement assets to come talk to us about the programs we offer as a potentially less volatile option.
You know, Bryce, if you lose 25% of your money, it takes about a 33% return to get back to even.
Right.
You know, Bob and Carol's situation and that story about 2008, they were down
over
50%, and it takes 100% return to get back to even, and that takes time. And there's about a 61% chance that you won't get back to even.
And it takes even longer if they're making drawdowns like they are.
That's exactly right. So, you know, take the opportunity right now, folks, if you're listening to us today, to take us up on our offer. Call us at 336-391-3409 and come in and let's sit down and take a look at your portfolio. We'll discuss our Beta Shield program for you.
It's a second opinion, folks.
It is a second opinion. You know, if you were sick and a doctor recommended you get an operation, you'd probably seek out a second opinion. Well, why not come seek out that second opinion about your financial health, your retirement health, with us?
It's like you say, Doug, no cost, no obligation.
Absolutely. Here's what we're going to do. We're going to analyze your current portfolio. We're going to find out what kind of risk you're actually taking for the rewards you're getting. Most people have no idea. They simply look at their accounts, and if it's going up, they're happy. If it's going down, they're unhappy. Do you know what risks are really in that portfolio? More importantly, do you know how much in fees you're paying? I
would reckon, Doug, that 100% of our clients would underestimate the percentage of fees that they're paying, 100% of them.
I would say 100% of everybody listening underestimates their fees. You know, yeah, you're going to pay a 1.25% management fee to the broker, but there's also mutual fund costs involved. On average, a portfolio is probably laden with about 3.25% in fees.
And we've seen some as high as 7%.
Yeah, and we're going to show you exactly in dollars and cents how much you're paying in fees. We're also going to stress test your portfolio. We're going to show you how your portfolio would have reacted in 2008. And you'll see for yourself how much money you stand to lose. So you owe it to yourself to get this analysis. Now, it's going to cost you something, time. It's going to cost you just coming in and sitting down with Bryce and I for a couple of meetings, 3 or 4 meetings, and they take about an hour each.
And we're not trying to scare anyone out there. We're just trying to make them aware, right, Doug?
Absolutely, because now is the time. There is a mighty bear market out there somewhere. I don't think it's anytime soon, but now is as good a time to prepare for it as any. So again, call us at 336-391-3409 and get on our schedule because it truly is filling up pretty fast. You know, Bryce, you and I were having a conversation just this week with some folks that came in, and I thought you were giving them some really sound advice. You want to tell the listeners what you told these folks?
Well, Doug, you know, a lot of the people that we talk to are people who are either in retirement or quickly approaching retirement. And what they've done is they've invested their entire life, stocks, bonds, mutual funds, and they've created that nest egg. Hopefully, and if you're successful, you've created that nest egg that's large enough to get you through retirement in the way that you envision, that you can lead the lifestyle that you are hoping to. And I was telling some clients of ours yesterday about some clients that I had had previously. She had successfully saved, created this beautiful nest egg for herself by taking risks in the market, as most people do, from age 25 to 55, whatever it may be. And we're trying to tell her that what you need to do now that you've successfully created this nest egg is to switch the strategy to protect it. You're no longer trying to grow the investment. You've already created exactly what you wanted to create so that you can go on the vacations. You can leave the nephews and the kids the money that you want to. And she couldn't do it. She said, this is what has gotten me through. This strategy is what's gotten me through up to now, and this is what I'm going to keep doing. And it could not persuade her to not basically still sit at the gambling table. You can protect that nest egg now with some different strategies, and if another 2008 happens, you'll sleep soundly every night. You won't have to worry about what the market's doing. And folks, you have to learn how to change your strategy when you're going from an income generating part of your life to drawing down the income in order to replace that paycheck that you get. That's called retirement. And you have to change your strategy at that point in time, or even a little bit before that time. And that's one of the main obstacles that we come into with our clients, is getting them to see that when you change the point of life that you're in, you need to change the investment strategy that you're using as well.
You know, Bryce, it sounds to me like the big old bad greed monster bit her a little bit.
Well, it will when the next bear market comes. I can promise you that.
You know, the problem is human beings are subject to this thing called the normalcy bias. And that's the idea that as things go, they'll always go that way. And right now we've been in a bull market for 9 years.
That's
and
a good way of putting it. Yep.
People are just, thinking that it's just going to continue and continue and continue. But it's not. We're starting to get close to the end of the program now, and I'm going to leave with one last story. I'm never going to forget this lady who came in to see me wanting a second opinion about a variable annuity she'd bought in 2006. And this was in that dark belly of 2008 when things were just so bleak. She'd lost 40% of her account by then. But she thought in 2 more years she could exercise her 6% guaranteed income rider and bail out with 6% growth. I then had to tell her that she had misunderstood how that rider works. That's only going to give her a lifetime income, much like a pension, and not a lump sum. Well, I explained to her she wanted to bail out with a lump sum. It's whatever her equity value was, which, remember, was down 40%. She turned pale white. Then I told her the market would have to go up in order for her to get out with a lump sum equal to what she put in it, and there's no telling how long that could take. Well, at this point, she mumbled something, and she goes, "But this is my retirement." Then she started crying. She started saying, "No, no, no." I got up to try to console her, but she grabbed all of her papers and just ran out of the office. And I never heard from her again, and I don't know how she fared. I hated to tell her the truth about her variable annuity, but at least I didn't sell it to her, and I have that guilt on my conscience. But that's a variable annuity story for another day. But I'll never forget that one. And,
Doug, there are probably a lot of people out there listening who can relate in some fashion to that, or at least you've perked up their ears and they're wondering, well, maybe I don't understand exactly what I'm invested in to the degree that I should, and how do I figure that out? How do they figure it out, Doug?
And it is a very heartbreaking story there too, Doug.
It shook me up pretty good, but that's just one of many that I saw during that time. And not to pat myself on the back, but the calls I got from my clients back then was thanking me for protecting them in 2008. And they told me stories about how their neighbors and their family members had lost 30, 40, 50%, or even more of their retirement. They were devastated. And I suppose that's why I've dedicated these shows to trying to educate the public that they need to be prepared for the next bear market, because it will come, just like it did in 2008. Well, we're about out of time today, and we firmly believe that planning ahead is the most important thing you can do to help secure your financial future. You just remember, this lack of planning leaves your wife potentially exposed to financial hardship later in life. Remember, guys, our wives live longer than us on average. So don't leave her with the devastation of 2008 on her hands. If there's one thing we hope you take away from this show today, it's that we want you to begin taking control of your financial future. You can start by having a conversation with your husband or your family. Start educating yourself about wealth management, financial planning, and investing. Do you know what questions to ask to assure that your financial decisions are based on facts and logic, not emotions and opinions? Don't sit on the fence because the market's doing well today. Please contact us for that no obligation review, that second opinion, if you will. Let us help you determine if you're making sound financial decisions based on fact and logic, not myth or misconceptions. Let's identify the money that is potentially falling through the cracks. Call us at 336-391-3409 or come and attend our educational Social Security workshop in August. Well, that's about it for today's show. I've enjoyed being with you today, and we will see you next week right here on the Wealth Guardians radio program on 94.5 WPTI.
Take care, everybody.